Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, let's start with the numbers. $53.58. That is exactly where Pan American Silver Corp closed yesterday, Monday, February 2nd, 2026. Market cap is sitting at $23.01 billion. We saw about, 6.5 million shares trade hands, which is significant volume. But if you're just looking at the closing bell, you are missing the violence that happened in the interim.
Violence that's the right word. You're talking about that crater left in the chart from last Friday, January 30th?
We're dissecting the aftermath of what the street is calling the Warsh shock. Kevin Warsh gets nominated for Fed chair, and the market immediately prices in a regime of aggressive rate hikes, and silver futures just collapse 31.4% in a single session. Pan American ticker PAAS, it dropped 8.2% on double its average volume. It was a complete liquidation event.
It was a reality check.
Well, that's the core question we're debating today, isn't it? Is the stabilization we're seeing in this $53 to $56 range a technical floor for a premier asset that is now trading at a massive discount? Or is this just a pause before a much deeper liquidation as we enter a new macroeconomic era? I see a best-in-class operator that's been irrationally punished by algorithmic selling.
And I see a falling knife. I see a macro environment that has just fundamentally broken the entire silver investment thesis, coupled with geopolitical risks in Latin America that investors are just ignoring because they're too busy looking at outdated moving averages. You see a sale, and I see a value trap.
Okay, let's lay out the bull case, because I think the market's reaction here is emotional, not structural. Pan American Silver has evolved. This is not the fragile junior miner people might remember from the volatile days of, the early 2020s. This is a financially resilient, multi-asset major. If you look at the balance sheet from the end of 2025, they are sitting on $1.32 billion in cash and short-term investments. And on top of that, a $750 million undrawn credit facility.
Liquidity is great, but it's not revenue.
It's a fortress, though. It prevents dilution. And speaking of revenue, the valuation disconnect right now is it's staggering. Pan American is trading at a forward PE of roughly 15.6 to 19.2 times. Now, for context, and context matters here, look at a peer like First Majestic. They are trading at a premium forward PE of 48.5 times. So the market is pricing Pan American like it has some kind of structural defect. But when you look under the hood, it's a cash flow machine with diversified streams.
You call it a disconnect, I call it a risk premium. Cheap is the most dangerous word in investing when the risk profile is this high. You mentioned the war shock like it's just some weather event that passes. It isn't. It's climate change. If Warsh comes in and actually crushes inflation, the entire silver investment thesis, which for the last 3 years has relied on silver being an inflation hedge, it dies.
But silver is industrial, not just monetary.
We can debate the industrial side, sure. But look at the volatility. This isn't some blue chip utility. The stock currently has an implied volatility rank of 99%. For anyone listening, that means options premiums are sky high because traders are pricing in extreme turbulence. This is a high beta danger zone. And we haven't even touched on the jurisdiction. You are buying assets in Mexico and Guatemala right as resource nationalism is surging. You're buying a house in a bad neighborhood just as the landlord, the Fed, decides to triple the rent.
I think bad neighborhood is a gross oversimplification of a complex geopolitical landscape. But let's get into the weeds of the business model first. This is where I think the bear case usually misses the nuance. You're worried about the spot price of silver dropping. I get that. But Pan American has insulated itself through what I call operational magic, their byproduct credits.
Operational magic. You mean standard accounting.
Well, it's standard accounting executed at an elite level. Pan American isn't just digging for silver. They produce substantial amounts of gold, zinc, lead, and copper. In mining economics, when they sell those base metals and that gold, they credit the revenue against the cost of producing the silver. It artificially but legitimately lowers the cost basis.
Walk us through the actual numbers then, because lowering costs is kind of a vague promise.
Okay, perfect. Look at the Cerro Moro mine in Argentina. For 2026, the forecast is for a negative all-in sustaining cost, or AISC, of minus $25.75 to minus $21.75 per ounce.
Okay, stop there for a second. You have to explain that to someone who isn't a mining engineer. Negative cost? It's not like they're handing out cash with every ounce of silver.
No, but effectively, yes. The revenue from the gold produced at Cerro Moro is so high that it pays for the entire operation. The digging, the processing, the salaries, and it leaves a surplus. So every ounce of silver that comes out of the ground is essentially free profit, plus the surplus from the gold.
It's a nice trick, provided the gold price holds up.
And it's not just Argentina. Look at Juanicipio in Mexico. They own 44% of it. In Q3 2025, it posted a negative AISC of $7.34 per ounce and paid out a $44 million dividend to the partners. This is high-margin production that survives even if silver prices collapse to $30. They aren't just surviving, they are printing cash at the asset level.
See, this is exactly where the safety net argument tears. You are relying entirely on the prices of the byproducts. You're telling me, don't worry about silver dropping because zinc and lead will save us. But think about the macro. If Warsh hikes rates, we probably hit a recession. In a recession, industrial demand for zinc, lead, and copper, it evaporates. Those credits vanish, and suddenly that negative cost becomes very positive very quickly.
You're assuming a total commodities collapse.
I'm assuming correlation. And honestly, Pan American is basically a gold company in disguise at this point. They produce over 742,000 ounces of gold in 2025. The silver segment is relying heavily on gold prices staying at historic highs. And then you have to look at the assets where they don't have those massive credits to hide behind.
You mean La Colorada?
Exactly. La Colorada costs are projected at $33 to $35 per ounce for 2026. Why? High sustaining capital expenditures, CAPEX, for storage and ventilation. San Vicente in Bolivia is looking at $41 to $43 per ounce. So you have some stars, sure, but you also have some very expensive, aging assets that are just bleeding money if silver sits at $30. You can't just cherry pick the negative ASC mines and ignore the heavy bleeders.
Well, La Colorada is actually the perfect transition because you're looking at a snapshot of 2026 costs, which are high because of investment. You are ignoring the massive growth engine sitting right underneath those ventilation shafts, the La Colorada Skarn project.
Ah, the Skarn. It's been the next big thing for, 5 years now?
Because it is world-class, it takes time to define a deposit of this magnitude. They've refined the strategy for 2026, moved to a two-phase development plan to lower the upfront capital. But the catalyst, the thing that is going to move this stock in the next 6 months, is the updated preliminary economic assessment, the PEA, coming in Q2 2026.
A PEA is a paper study. It's not a mine.
It's the roadmap to value. This PEA is going to clarify the net asset value, the NAV. We are talking about a deposit where drill hole S7725 returned 3.66 meters at 3,844 grams per ton of silver. Do you understand that grade? That is, it's geological insanity. You just don't see those numbers in modern mining.
It's a spectacular hole, I will grant you that. 3,000 grams is rich, but a hole in the ground isn't a business, specifically not in Mexico right now. You are banking on a PEA in Q2 to re-rate the stock, but are you pricing in the fiscal reality that started 30 days ago?
You're referring to the tax reform.
The tax reform that went into effect on January 1st, 2026. Mexico raised the special mining duty to 8.5%. They increased surcharges on tax assessments. This is a direct attack on the margins at La Colorado and Juanicipio. So your profit models for those cash cows, they're likely using 2025 tax assumptions. I suspect the advocates' optimism isn't fully pricing in this fiscal tightening. You're expecting a re-rating on the PEA. I'm expecting a margin compression on the earnings sheet.
The tax increase is a headwind. I acknowledge that, but companies adjust. Global miners are used to shifting tax regimes, and you are completely ignoring the optionality in the rest of the portfolio. Look at Escobal in Guatemala.
Oh, please, don't tell me you aren't valuing Escobal. That asset has been dead money for years.
It is a free option at this price point. The market has assigned it zero value. And it's an if, but if it reopens, production jumps 70 to 80%. It is one of the premier silver mines in the world, just sitting on care and maintenance. It's a sleeping giant.
It's not sleeping, it's in a coma. And it's a liability, not an option. The Zinca Parliament reaffirmed their opposition in May 2025. In November 2025, just 3 months ago, they delivered a petition with 6,000 signatures demanding its permanent closure. Care and maintenance cost money. You're burning cash to guard a hole that the locals physically will not let you open. And socially, the friction is immense. You can't model a reopening in Excel when the local population is mobilized against it. It's a pipe dream.
It is a complex social undertaking, yes. It requires patience, but Pan American has the balance sheet to wait it out. And that brings me to the stewardship of capital. Michael Steinman. He's been CEO since 2016. He's a geologist, not a finance guy, with over 20 years in the industry. He is a disciplined allocator.
I have some thoughts on the allocation, but go on.
Just look at the results. Record attributable revenue of $884.4 million in Q3 2025, free cash flow of $251.7 million. He integrated Yamana Gold, he integrated Mag Silver. These were massive, complex acquisitions, and they are working. The institutional money sees this. Look at the shareholder registry. VanEck holds a $2.9 billion position. BlackRock increased their stake by 42.2% recently. Vanguard is there. This is high conviction ownership from the smartest money in the room.
You call it smart money. I prefer to look at the inside money. Because if the story is so good, if the scarn is world-class, if the balance sheet is a fortress, why are the people running the company hitting the sell button?
Executives sell for tax planning and diversification all the time. That's standard practice.
In the 3 months prior to February 2026, insiders sold $8.6 million in stock. But let's look specifically at the man you just praised, Michael Steinman. He sold roughly $1 million worth of stock in December 2025.
The stock was near $70. He took some chips off the table.
Exactly. He sold at the absolute top. If he believed in this silver supercycle, if he truly believed silver was going to $100 like the bulls claim, why would he cash out $1 million just before the year ended? That is a massive signal. He sold into the strength that retail investors were buying. That doesn't scream confidence to me. It screams profit-taking.
Or it screams prudent financial planning after a 178% run-up in the share price over the last cycle. He still has significant skin in the game, and the operational changes, promoting Scott Campbell to COO, keeping Steve Busby as a special advisor, that shows they are managing the continuity well. They aren't checking out.
Well, I'm also looking at the safety record, which is a leading indicator of operational stability. 2 fatalities in 2024 at Dolores and Huaron, an ESG score of 67 out of 100 from S&P Global. These numbers matter. They indicate operational friction. When you're pushing for volume in complex jurisdictions, things break. Safety issues can lead to shutdowns just as fast as tax reforms can.
They've implemented the Doing Safety Differently program to address exactly that. They aren't ignoring it. But let's bring this down to the bottom line for the listener. The so what factor. Let's say I have $5,000 to invest today. I buy roughly 91 shares at these levels. What happens?
All right, run the numbers. But be realistic.
Okay, if we look at the bull case, Bank of America Securities has a price target of $73. That is not fantasy. It's an institutional model. That $5,000 investment grows to about $6,679 in 12 months. That's a 33% return. That beats almost any savings account, bond, or index fund projection in a high-rate environment.
That assumes Beaufet is right about the metal prices.
And if we look at the long-term supercycle case, which is my base case, where silver hits $100 per ounce due to the solar and EV demand deficits we know are real, the share price implies a fair value of around $102. That $5,000 nearly doubles to $9,333. You are getting paid to wait with a dividend that was just raised to 14 cents a share, and you have massive upside leverage. This is asymmetric upside.
Now let me give you the reality check. The bear case. The war shock isn't a one-week event. Silver revisits the 2025 lows because rates stay high and the dollar strengthens. The technical target there is $38. Your $5,000 investment shrinks to $3,477. You lose 30% of your capital.
That is a pretty severe downside scenario, assuming a total macro collapse.
It's a realistic one given the 99% implied volatility. And even if we take the consensus, Scotiabank is at $64. That turns your $5,000 into $5,856, a 17% return. Is 17% potential upside worth the risk of holding a stock that swings 8% in a single day? Is it worth the risk of the Mexican government squeezing another 5% out of the margins? I just don't think the risk-reward creates a compelling entry here.
I think you're focusing too much on the floor and not enough on the ceiling. The price to net asset value, PNAV, is only 1.3x right now. Historically, these stocks trade at 2.0x NAV in a bull market. We're at the bottom of the valuation cycle for a company that is technically printing money through its byproduct credits.
Or we are at the beginning of a re-rating downwards because the macro tides have turned. You're valuing it like it's 2024. It's 2026. The world has changed.
It sounds like we're looking at the same data, but seeing two very different futures. You see the geopolitical and macro headwinds as insurmountable barriers.
I see them as structural risks that are not priced in. Pan American is a well-run company. I won't deny that. Steinman is a pro, but he's running a company in bad neighborhoods facing a hostile Fed. And that insider selling at $70 is the loudest signal in the room for me. My advice to anyone listening is, caution. Wait for the Q2 PEA. Wait to see the impact of the Mexican tax reform on the actual earnings sheet before you deploy capital. Don't try to catch the falling knife just because it paused at 53.
And I see why you'd be cautious, but fortune favors the bold, or at least the well-researched. The market has overreacted to the Warsh news. This is an emotional sell-off, not a fundamental one. You have a conservative valuation at 1.3x NAV, a massive cash pile of $1.32 billion that protects the downside, and a clear path to margin expansion. Analysts project margins hitting 42% by 2029. I view $53 not as a pause, but as an entry point for a stock that will fundamentally re-rate higher.
Margins of 42% in 2029 assumes the tax regimes don't get worse. That's a big assumption given the trend in Latin America.
It is, but that's the nature of resource investing. You manage the risk. And speaking of managing expectations, we won't have to wait long to see who's right about the immediate impact.
That's true. The Q4 2025 earnings call is coming up on February 18, 2026.
Yep, just a couple of weeks away. That will be the decisive moment. We'll see if the margins held up through the end of the year and get fresh guidance on the tax impact.
Until then, watch your stops.
And watch the volume. Thanks for listening to The Debate.
Stay skeptical.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.